Joseph, are we seeing any evidence already of collateral damage in this part of the world as a result of America's trade aggression against China?
It's still early days in terms of seeing the impact, at least in the data, of some of these trade measures. But what I will say is that actually we're already seeing some slowing momentum actually in the tech cycle, in exports in Asia already over the past few months. So that's happening almost independently of these additional tariffs. So in a sense, it's not coming at the best time.
Interesting, because the region is ultimately very trade dependent. As we were just discussing, Singapore and Malaysia are just two key examples. Who else could potentially be impacted by this? Who is most at risk?
So it ranges, but in Southeast Asia, I would say Singapore, Malaysia, Thailand and Vietnam, those tend to be the most trade-intensive economies. But really, in terms of the actual impact, it depends on quite a few factors. So from the Chinese perspective, for example, it depends on what goods are the tariffs being put on. For example, if it's on a final consumer good, those are the most dangerous for the rest of Asia because there's simply various components that come from every country that are assembled in China and then exported as a final good. And for the most part, the USTR, the US Trade Representative, is trying to avoid tariffing those goods as long as they can because they know it'll have a big impact for US consumers. At the same time, we also have a relatively strong response from Chinese policymakers in terms of domestic policy, in terms of ensuring that domestic demand remains stable despite any disruptions, small disruptions on trade. And that ultimately is even more important for the rest of Southeast Asia, that the Chinese economy remains strong.
And I was looking over some HSBC research which also suggests that Indonesia and the Philippines are likely to be shielded perhaps a little bit more than other ASEAN economies. Why is that the case?
So if you look at their economies, actually, in Philippines and Indonesia, exports are only roughly 20 or 16% of GDP for these two countries, compared with over 50% in terms of some of the more trade-intensive economies. That's not to say that they won't be impacted. And like we were talking about a bit earlier, in Indonesia's case, it doesn't have to be the direct trade impact. It can be the risk-off impact on capital flows, which then hits foreign positioning in Indonesia's bond market, and you see the impact from that channel. I will also say that Indonesia's exports to China are still very much in the commodity space, over 75%. And while that does lead to some sensitivity, you'll only see that impact if the Chinese economy, if domestic demand starts to slow. You're not necessarily going to see the immediate impact of a disruption to electronic supply chain, for example, which would impact other economies in the region.
Still watching? Perfect. Click here to watch another great video from CNBC International. Oh, and don't forget to subscribe. Thanks for watching.